Chicago, 1994. The S&P pit was a shark tank, a deafening, claustrophobic wall of sound. In the center of the madness sat a young trader named Mark. Mark wasn't moving. He's paralyzed. He's long on a position that has moved $4 against him, and he's watching 6 figures of equity vanish in real time. He wasn't trading anymore. He's performing a frantic, silent prayer to a market that doesn't have ears. He's scouring the chart, desperate for a lifeline, a Fibonacci level, a moving average, a headline. Anything to justify his refusal to click sell. An old-timer named John, a man who has survived 3 market crashes and still wears a tattered trading jacket like armor, leans over Mark's shoulder. "You like that stock, kid?" John said, not looking at the monitors, but looking at Mark's white knuckles. Mark replied with certainty, "I know it's going to bounce, John. The fundamentals are solid. This is just a shakeout." John grinned and said, "Forget what you know. Imagine you just walked in off the street. You've got 0 positions and $1 million in cash in your pocket. You look at that screen right now. Would you buy that stock at this exact price?" Mark looked at the screen without the hope of his entry price. The truth is naked. He saw a falling knife. He saw a trend line snap like a twig. He saw a market that wanted blood. "Well, no, not here. I would wait for it to stabilize," Mark said while his voice broke slightly. "Then, why the hell are you holding it?" John screamed at him. John's logic was surgical. Every second you hold a position, you are choosing to buy it again at the current price. In psychology, this is called the endowment bias, the mental glitch that makes us overvalue something simply because we already own it. In trading, it's a death sentence. By refusing to exit, Mark was betting that the Mark of 10 minutes ago was smarter than the Mark of right now. He was married to a ghost. Risk management isn't a set of annoying rules your broker makes you follow. It is your biological survival system. It is the only thing that allows you to trade tomorrow after losing today. It is the boundary between a professional career and stories told as lessons of what not to do. If I had understood the blank slate test earlier, I wouldn't have burned many trading accounts to the ground. But I am making this video so you don't do the same thing. In this video, I'm going to give you the 5 pillars of risk management that actually work. This isn't the generic fortune cookie advice you see everywhere. These are the battle-tested principles that protect your capital when the world starts burning. Risk management pillar number 1. Know your real risk tolerance, not what sounds good. After I blew my first trading account, I did what most desperate traders do. I asked for help, and every guru gave me the same advice. Risk 1 to 3% of your capital per trade. So, I picked 3%, the high end, because I wanted to make it worth it. 3 losing trades later, I was down 9%. 5 more bad trades, I was down 15%, and I completely lost my mind. I started revenge trading, over-leveraging and making desperate decisions. If you are not new here, you know how that story ends. But one important thing that I learned from that phase of my trading career, and what people don't talk about, is that risk tolerance is not a number you pick because it sounds professional. It is the amount you can lose repeatedly without losing your composure. After years of blown accounts and working with prop firms, I now risk 0.25% to 0.5% per trade. For me, that is it. That's my risk tolerance. I could lose 10 trades in a row at that percentage and still think clearly, still execute my next trade without emotions, and still sleep well at night. That is my risk tolerance. Not 3%, not 1%. That's what I can actually handle psychologically. Your risk tolerance isn't what you can afford to lose financially. It is what you can afford to lose emotionally. You might have $10,000 in your account and be able to afford a $500 loss on paper. But if that $500 loss makes you obsess over getting it back, question every decision for the next week. and abandon your trading plan out of fear or desperation, then you can't actually afford it. Risk tolerance is deeply personal, and there is no correct number. The goal isn't to match someone else's number. The goal is to find what keeps you functional. Your risk tolerance needs to evolve. What felt comfortable at $5,000 might feel terrifying at $50,000, even though 1% is the same percentage. As your account grows, as market volatility changes, as your life circumstances shift, you need to reassess. Another important thing to note is, your risk tolerance isn't set in stone. It is a living boundary that protects your most valuable asset, your ability to think clearly under pressure. Get this wrong, and nothing else matters. Get this right, and everything else becomes easier. Risk management pillar number 2. Prepare for the worst, because it will happen. Most retail traders treat a disaster, a 5-trade losing streak, or a sudden news-driven gap as a glitch in the system. They view these moments as anomalies that shouldn't have happened according to their technical analysis. But in professional trading, disaster is not a glitch. It is a scheduled event on a calendar where the dates have been blacked out. You don't know when it will happen, but you must know exactly what you will do when it arrives. When you are blindsided by the market, your brain naturally defaults to the most expensive strategy in the world. Hope. Hope that the price will bounce off a support level it has already broken. Hope that the next candle will miraculously end a losing streak. Hope that the market will eventually realize your analysis was correct. Hope is a psychological red flag. It is the reaction of a trader who's no longer in control. Professionals do not hope. They execute. The traders who survive for decades are not the ones who avoided the hell weeks. They are the ones who calculated the cost of entry into those weeks and stayed within their limits. They understand that long-term profitability is a mathematical result of this equation, which says survival equals tested edge minus emotional intervention. If your emotional intervention, panic, revenge trading, or freezing is high, it doesn't matter how good your edge is, your survival probability drops to 0. So, if you want to move from a state of hoping to a state of planning, you must perform a pre-mortem. Before the market opens every Monday, you need a pre-calculated answer to these 3 questions. 1. What is my hard stop for the week? If I hit X losses in a row, will I close my terminal to preserve both capital and sanity? 2. If the market gaps significantly against my position, do I have an emergency exit? Or will I freeze and wait for a pullback that may never come? 3. Is my position sizing small enough that a 1 in a million event merely bruises my account instead of burying my career? You will eventually face a trade that moves violently against you. You will face a streak that makes you question your intelligence and your worth. In those moments, the version of you that survives isn't the one who is stronger or smarter. It is the one who is prepared. Risk management isn't about avoiding the fire. It's about having the sprinkler system installed before the match is lit. Now, speaking of preparing for disaster, let me tell you about something that happened to a trader I know during the Swiss franc crisis of 2015. He woke up one morning, and his account wasn't just at 0. It was negative $30,000. He didn't know the market. He owed his broker. One overnight gap blew straight through his stop loss, like it didn't even exist. And just like that, he was in debt for money he never even had. That's the nightmare scenario most traders don't think about until it's too late. Market gaps, extreme volatility, flash crashes. These aren't theory. They happen. And when they do, your account can go negative faster than any stop loss can react. This is why I trade with a broker that has negative balance protection built in, and why you should too. Here's how it works. Let's say you deposit $1,000. The market moves violently against you. Maybe a surprise rate decision. Maybe a geopolitical shock. Maybe one of those freak events that seems impossible until it isn't. Your position gets stopped out, but the gap is so severe, your balance drops to negative $500. Without protection, you owe that money. With negative balance protection, your balance is automatically reset to zero. You lose what you deposited, but you don't owe anyone anything. That's the difference. I trade with Ultima Markets because this protection is included on every account. No extra cost, no special request, no premium upgrade. It's just there. And honestly, it should be standard everywhere. But it isn't. If you want this kind of protection, I've put a link to Ultima Markets in the pinned comment and in the description below. It takes 2 minutes to set up, and it could be the difference between a recoverable loss and owing money you don't even have. Risk management pillar number 3, the time stop. Most traders believe that if a trade hasn't hit their stop loss, they are still safe. They will sit in a stagnant sideways position for hours, or even days, telling themselves, my analysis is still valid because I haven't been stopped out yet. The professional reality is different. A trade that does nothing is a failed trade. Every minute you spend in a trade that is moving sideways is a minute your capital is dead. There is the financial cost that margin is tied up in. You cannot use it to take a high-quality setup that might appear on another pair. There is the psychological cost. Stagnant trades act like open tabs in your brain. They drain your emotional energy and focus, making you more likely to miss the next big move because you are busy babysitting a zombie position. You entered a trade because you anticipated a specific reaction at a specific time. If you bought a breakout, you expected immediate momentum. If you bought a support bounce, you expected a rejection. If the market price simply hangs there, the reason you entered the trade has effectively expired. The market is telling you that the buyers and sellers are in equilibrium, which simply means your edge has vanished. To implement a time stop, you must decide on a lifespan for your trade before you click buy or sell. This is usually based on the time frame you are trading. Here is how to implement a time stop. 1. The 3-candle rule. If you are an intraday trader and the price has not moved significantly in your favor within 3 to 5 candles of your entry time frame, you close the position manually at market price. 2. The session rule. If you enter a trade based on London open volatility and that trade is still flat when the New York session begins, the environment has changed, so you exit. 3. The pillar rule. If the momentum you expected hasn't arrived within your designated time window, exit the trade. It is better to be out of the market wishing you were in than in the market wishing you were out. When you master the time stop, you become a high-efficiency operator. You stop hoping for moves and start demanding that the market proves your thesis immediately. This keeps your capital liquid, your mind sharp, and your equity curve moving. Risk management pillar number 4, volatility-adjusted sizing. In the professional trading arena, the most dangerous mistake a trader can make is treating every asset as if it has the same pulse. A 50-pip stop loss on a sleepy Tuesday in Euro-USD is a conservative distance. That same 50-pip stop on gold during a New York Open? That is not a strategy. It is essentially a donation to the market. Professional traders don't pick stop-loss distances based on how they feel. They pick them based on how the market breathes. Most retail traders use static stop losses. For example, always risking 20 pips regardless of what is happening. This is mathematically flawed because it ignores the noise floor. If a pair is currently swinging in 30-pip intervals just to move sideways, a 20-pip stop will be hit by random noise every single time, even if your direction is 100% correct. To fix this, I personally use the average true range, ATR. The ATR tells you the average distance an asset has moved over a specific number of periods. It is the literal blood pressure of the market. When the ATR is high, the market is violent, and it means you need a wider stop loss to stay out of the noise, which means you must use a smaller position size to keep your dollar risk the same. And when the ATR value is low, it simply means the market is quiet. This time, you can use a tighter stop loss, allowing for a larger position size while still maintaining the same total risk. When you adjust your size based on volatility, you achieve standardized risk. When you do this, a loss on a chaotic, high volatility day feels exactly the same as a loss on a quiet, slow-moving day. Doing this means you have removed the emotional trauma of the big hit because you have accounted for the environment before you ever clicked buy. The lesson here is simple. Never set a stop loss based on where you want the market to stop. Set it based on how the market is actually moving. Let the ATR dictate the distance, and let that distance dictate your size. Risk management pillar number 5. The equity curve circuit breaker. In the high-stakes world of institutional finance, no trader is allowed to lose an unlimited amount of money. Every professional fund operates with a strict max drawdown limit. The moment a trader hits that number, their terminal is locked, their positions are liquidated, and they are forced away from the desk. This is the equity curve circuit breaker, and it is your final line of defense against the most dangerous version of yourself, the one that is tilted, desperate, and looking for revenge. Most retail accounts don't die from a single bad trade. They die from a bad week that isn't allowed to end. When you hit a string of losses, your brain undergoes a chemical shift. Your logical prefrontal cortex shuts down, and your amygdala, the seat of fight or flight, takes over. You begin revenge trading, doubling down to get back to even. The circuit breaker is designed to stop this biological process before it clears out your bank account. It is a hard stop on your account equity, not just an individual trade. The equity curve circuit breaker rule dictates that if your total account equity drops by a predefined percentage, typically 10% to 15%, within a single month or a single streak, you stop trading immediately. No, one last trade. No, changing the strategy. You shut down your computer. This isn't just about saving money. It's about perspective. Often, a deep drawdown is a signal that your strategy is no longer compatible with the current market environment. For example, trying to trade breakouts in a choppy, range-bound market. It takes time for the stress chemicals in your brain to dissipate. You cannot re-evaluate your strategy while you are still feeling the sting of the loss. When the circuit breaker trips, you are required to perform a post-mortem audit, and you cannot return to the markets until you can answer 2 questions. Was this a good drawdown? Did I follow my rules and simply hit a statistical losing streak? Was this a bad drawdown? Did I break my position sizing? Skip stops or revenge trade? If it was a good drawdown, you return when the market regime shifts. If it was a bad drawdown, you return only after you have identified the psychological trigger that caused the lapse in discipline. The equity curve circuit breaker is the only thing that stands between a rough month and a career-ending disaster. It turns a potential exit from the industry into a temporary hiatus. Establish your max drawdown number today. Write it down. Put it on your monitor. And if you hit that number, you are no longer a trader. You are an observer until the new month begins. In the 14th century, sailors believed that if they sailed too far, they would fall off the edge of the world. They were terrified of the unknown. In trading, the edge is real, and it's called ruin. But the edge isn't a place on a map. It's a state of mind. It's the moment you decide your analysis matters more than your risk plan. If you want to go deeper into the exact science of doing risk management the right way, watch this video next. And thank you for making it to the end. I truly appreciate you. If this video gave you insight, hit the like button, subscribe to the channel, and turn on notifications. so you don't miss what's coming next. I'll see you in the next one.